Hi everyone, welcome to a brand new episode. I'm Marcus and today we're looking at Mastercard. So what's on the news? Well, we have an article here on Wall Street Journal titled Walmart, Target urge lawmakers to pass bill taking aim at Visa and Mastercard fees. So more than 1,600 merchants including Walmart and Target are urging U.S. lawmakers to pass a legislation that aims to break the hold that Visa and Mastercard have over the credit card market. The bill, which Senator Richard Durbin and Senator Roger Marshall introduced in July, would give merchants the right to route many credit card payments over networks other than Visa and Mastercard. In a letter to all members of Congress, the merchants said the proposed legislation would increase competition, leading to a reduction in the fees they pay when they accept credit cards. In 2021 alone, U.S. merchants and consumers paid nearly $138 billion in card fees. So the two networks together handled roughly 77% of all general purpose credit card spending last year on cards issued in the US, according to the Nelson Report, a trade publication. Wow. So if this goes through, that will have a major hit on Visa and Mastercard. But let's take a look at the numbers, shall we? If we look at the screen, we can see that Mastercard is traded on New York Stock Exchange and are in the trade and service sector. Their market capitalization coming in at $304.5 billion and their revenues at $20.9 billion. PE ratio at 31.9, a bit high, but whenever you see stock with a high PE ratio, that tells you that the market expectation of their stock is high. Therefore, there are a good chance that we might see stock price increase. But with everything that goes on in the market, I believe we'll see further down see a reduction in the PE ratio numbers. So we'll talk more about it later. But having a PE ratio of 31, that is too high for me. So that is a no. Profit margin coming in at 46.5. I like it. So that is great. That is just amazing. Price to sales ratio coming in at 14. That is too high. So that is a no for me. And price to book value at 49, also too high for me. So that is a no. So if we were to summarize, the PE ratio is too high, price to sales ratio and the price to book value is too high. This is telling us that Mastercard at its current state is overvalued. They pay out a dividend of $1.91. I like it because I like those recurrent income. Effective return at 0.6%. That is too low for me. I would like to see a range at least around 3 to 6%. But I believe with everything that goes on, we'll see the stock price decline and therefore giving us better returns. So, but at the current moment, that is a no for me. Return on equity at 151%. That is just amazing. Basically, what it's telling us is that the company is doing well when it comes to creating return on their equity. Basically, meaning if you invest in the company, you might see good. They are able to create return on those capital. So that is a plus. Return on asset coming in at 20%. That is a go. If we take a look, the stock is currently traded at $315 per share. If we take a look at the moving average, we can see that we are below the 50-day moving average, but also below the 200-day moving average. Basically, this is telling us that we might see the stock price decline. If we look at the chart, we can see that we have been more or less consolidating for quite some time, but now the stock price is nearing the support line around here. So we might see buyers come in and push the price even higher. So there is an opportunity here to maybe go in around 320, buy the stock for a push upwards to 340, 360 and get off the trade. But we'll take a closer look at the technical aspect further down. But let's head over to the income statement. What we can see here is that the total revenue went from $12.5 billion in 2017 and grew to $18.9 billion in 2021, and these numbers have been improving. We fell off a bit in 2020, but overall trend is positive. I like it. Gross profit went from $6.5 billion up to $10.2 billion, and these numbers have been improving. Fell off again in 2020, but overall trend positive. Net income went from $3.9 billion up to $8.7 billion. And these numbers have been improving every year, fell off again in 2020, but overall trend is positive. I like it. Now, let's head over to balance sheet. And what we're interested here is that the current assets versus the current liabilities. And we can see there's a huge difference between the current assets and the current liabilities, basically telling you if the company were to convert those assets to cash, they're able to pay off their current liabilities and still have capital left on the table. So that is a plus. I like it. But they are far from being able to pay off their total liabilities, which is negative. And we can see that the total liabilities went from $15.8 billion up to $30.3 billion, and these numbers have been increasing every year, so that is negative. Now let's look at the outstanding share. We can see it went from 1.1 billion shares down to 982 million shares, and over the last 5 years these numbers have been dropping. That is a plus. Basically what is happening here is that the company is doing buybacks, basically telling you that your share of the company is growing because there are fewer and fewer available shares out there. If we were to see these numbers instead increase, that would mean that the company is issuing more and more shares, and that's a way for a company to bring in more capital to take without taking out more debt. But at the same time, that means that your share of the company is decreasing. You're being diluted as investor, and there's a lot of investors and traders that don't look at these numbers because they'll be looking at the balance sheet and they see a company with a strong assets and the debt's not growing that much, and they think, well, we found a golden corn here. But at the same time, the company is issuing a lot of shares in order to bring in more capital. So be very cautious here. Now let's head over to the cash flow, and what we're interested here is that the operating cash flow versus the capital expenditure, and we can see the operating cash flow came in at $9.5 billion and the capital expenditure $814 billion, making a difference of 8.7% billion dollars. That is amazing. And we can see that operating cash flow have been growing from 5.7 billion up to 9.5, and these numbers have been improving. Fell off 1 year, but overall trend is a plus. And the capital expenditure went from 423 million up to 814 million, and these numbers have been improving. Fell off a bit in 2020, but overall trend is positive. I like these numbers. I like that the operating cash flow is improving year by year, and also that they continue to invest in their business. So that is a plus. Now let's head over to the key figures. And what we can see here is that the earnings per share went from $3.7 per share up to 8.8, and these numbers have been improving. Fell off in 2020, but overall trend is positive. Revenue per share went from $11.8 per share up to $19 per share, and these numbers have been improving. 2020 fell off a bit, but overall trend positive. Equity per share went from $5 per share up to $7.4 per share, and these numbers have been improving year by year. I like it, so that is a plus. Dividend per share went from 89 cents up to $1.77, and these numbers have been improving. I like it because I like those recurring income, and also the fact that the income is growing year by year, so that is a plus. Dividend share went from 24%, 17, 16, 24, and 20. I like this because I want companies that pays out between 20 or 60%, because I want some of those capital to remain in the business for acquisitions, for investment, or just overall strengthening the financials in the business. So seeing a range here, that means there's a lot of leg room for the future in order to pay out more or just have those capital and improve the financials. So I like this one. Gross margin went from 51.8% up to 53.8%, and these numbers have been improving, but over the last 2 years we've seen a bit of drop, but has of lately been a better numbers. But overall trend, I like this. But at the same time, guys, don't get just blinded by these numbers. We need to compare these numbers across the industry and see how is Mastercard doing compared to their competitors. But overall trend, I'm liking what I'm seeing here. We can see that the last 2 years cost of goods sold increased, but overall trend is still positive. Operating margin went from 52% up to 54.5%. We fell off in 2018 and improved, and then fell off again and then improved. Stagnation or a fluctuation. I don't like fluctuation because it makes it harder to determine the behaviors and determine the direction of the future. But seeing that we are improving, I like that. So that is a plus. Profit margin coming in went from 31% up to 45%, and these numbers have been improving. Fell off a bit in 2020, but overall trend positive. Return on equity went from 71.6% up to 118.6%. These numbers have been improving. Fell off in 2020, but overall trend positive. Return on assets went from 18% up to 23%, and these numbers have been improving. Same thing here, fell off in 2020, but overall trend positive. Solidity tells you about company's financial strength for the long term. And we can see it went from 25.6% down to 19.4%, and these numbers have been dropping. This is negative. Balance sheet liquidity, same thing as solidity, but here it looks at the company's financial strength for the short term. We went from 1.9 down to 0.9, and these numbers improved a bit, but have since seen lower and lower numbers. So this is negative. Debt ratio went from 2.8 up to 4, and these numbers have been growing year by year, and they dropped a bit lately, but overall trend is negative. Basically, debt ratio of 4 in 2021 tells you that the company had 4 times more debt than equity in the business. So that is negative, that these numbers are growing. So guys, we have gone through the income statement, balance sheet, cash flow, key figures. Now over to a key feature, which is our stock analyzer. Basically what it does is that it gives you a simplified, holistic overview of the company's performance, and it saves you a lot of time. If we take a look, we can see right away that PE ratio is above 20, which is negative. The company do pay out dividends, which is a plus, and the dividend payout rate is below 60%. That is a plus. And dividends have increased over the past 5 years. That is a plus. And number of outstanding shares have decreased. That is a plus. And revenue increased over the past 5 years. That is a plus. And profit margin above 15%. That is a plus. And profit increased over the past 5 years. That is a plus. Current assets are greater than current liabilities, which is a plus. Solidity decreased over the past 5 years, negative. Balance sheet liquidity decreased over the past 5 years, negative. And the debt equity ratio increased over the past 5 years, negative. And the total liabilities have grown over the past 5 years, negative. Guys, as you can tell, it gives you a simplified, holistic overview of the company's performance, and it saves you a lot of time. If you want to go through the numbers, you can go through the numbers or have the software do the heavy lifting for you. You can have this software along with everything we've gone through, plus access to our discussion forum where you'll be able to chat with me along with other members for only $10 per month. So make sure to head over to comus.se and become a member today. Okay, thank you. But now let's take a look at the technical aspect of the stock. So here we have the chart. As we guys can tell that we have for quite some time been moving in a positive trend channel, but as of lately seen the momentum decrease, and now we're actually seeing a turn. We're seeing, for instance, here that we're seeing lower highs, and also here we are seeing a support line, and basically we have a wedge over here. So with everything that is going on in the market, we're seeing increase in inflation rate, a lower consumer confidence. Even though the consumer spending is still high, there's a high levels of market participation, labor participation, and we saw recently in August that unemployment rate went from 3.5 to 3.7. So are we seeing a reversal here? It's too early to say, but with everything that goes on in the economy worldwide, we're seeing a decrease in the stock market. So I believe going forward that sure, we are within the wedge right now and are close to the support line. So I believe there will be, for the short term, a lot of buyers coming in and pushing the price even higher around 340, 360, hitting the resistance level, and then go back down towards the support line, and maybe even break below, for the long term, even break below these numbers. So if we break below these numbers, we'll see a sell-off here. And this is a great company, a lot of opportunities, stable numbers. They have their system in place, but I would like to, in order to get a better return, we need to see the stock price decrease, and I believe going forward we'll see this the stock price decrease. And if it goes down and we see effective return around 3 to 6%, I would be interested of buying. But at its current state, I believe the company is still overvalued. But for the long term, I hope to see the stock price decrease in order to for a buying opportunity. So how would you trade the stock? Please let me know in the comment sections below, and I truly hope you have enjoyed this episode. And please give me a thumbs up, comment, subscribe, and let me know what stocks you want me to take a look at. Until next time, guys, take care. Bye bye.